Thank you very much for the invite. I will start with a really brief presentation of myself. My name is Andriotto. I'm based in Switzerland. I'm an adjunct professor in finance in Italy and Switzerland. I'm part of a family office that has its head in Lugano. The name is SMC. Well, actually now the new name, as we have a new partner, is BSMC. We are present in 15 countries around the world. As I said, we have our head in Switzerland. We are a multi-family office. We invest in different type of assets with an opportunistic asset management strategy. Right now, personally, I'm pretty deeply involved in real estate, but maybe I will have the opportunity to speak about this later. Ukraine clearly, I would say Ukraine and Russia clearly have had a huge impact on Switzerland, because as you probably know, Switzerland has been at the safe for the Russian war for many years. Right, I would say that as happened, many oligarchs have had their funds taken by the authorities. They have been seized, and this, it seems to be also one of the reasons why the Credit Suisse have had so many issues and took the Credit Suisse to the default. I would say that for the energy crisis at the beginning, clearly had a huge impact, not just on Switzerland, but around all Europe, because clearly we don't have many raw materials that we can count on in this moment, and the policy in the previous year have been concentrated more in renewable energies than in finding a solid source of energy to feed the industry sector. I would say that now the crisis is a little bit, there is a better perspective on this. The price of energy is going down a little bit, even if there are still some problems. Today, the central bank, the European Central Bank, Mrs. Lagarde has declared that the interest rate will go up in the next month. So there are still some major concern about this. We'll see what happened.
Fantastic, great. Let's get on with the panel. Howard, do you want to introduce your people?
Sure. So my name is Howard Cohen. I'm off camera because, as I say at every one of these events, God gave me a face made for radio. So I think the best way for Ellen, Peter, Mauro, and Danye to start off is by introducing themselves. I'll defer to Ellen first. We'll just a couple of minutes each, and then we'll get into. They want me in the picture.
Yeah, Howard, get in the picture. You look adorable.
You don't really want this. So Ellen, why don't you just give a quick overview of yourself?
My name is Ellen Baker. I have a company called Baker Aurora. I consult the family offices and introduce them to alternative investments. Basically, they've come to me telling me the type of style they like, what they're looking for on one side. The other side is that because I have relationships with family offices, a few institutions, there are companies that investments that come to me, funds that come to me that are looking for investors. And it is my job to pick and choose what I think is most appropriate so that I don't bother the family offices, but in fact, I laser point to exactly what I think they're interested in.
Yeah, no problem. Danye.
Hi everyone. My name is Danye Wang. My firm is called UniGlobe Capital, which started off as a cross-border advisory firm focusing on Asia and the US. And in the most recent 2 years, really morphed into a multi-family office where I specifically advise a handful of Asian-based family offices on their US investment allocation with a focus on alternatives. And that is venture capital, early growth, some private credit, and real estate. And prior to running UniGlobe Capital, I was at BlackRock for most of my careers, dealing with institutional investors, mostly sovereign wealth funds, central banks, and insurance companies. So went from very large institutional relationships to managing family offices and focusing on the cross-border dynamics. And I was briefly a entrepreneur myself. I co-founded an edtech platform focusing on career development for international talents.
Mauro?
Yeah, so as I said, I'm an adjunct professor in finance in Italy and Switzerland. I'm part of a family office. The name is DSMC. We are present in 15 countries around the world, from China to South America. Our head is in Switzerland, where we have offices in every city around Switzerland. I'm also part of the Swiss Chamber for Blockchain and Digital Finance, together with the former president of the Swiss Senate, Mr. Filippo Lombardi. I'm the former quantitative leader of Ernst & Young for the South Europe, and I have been an advisor of the European Commission for venture capital selection of companies under the Horizon program, that is a 95 billion program for financing and fostering innovation around Europe. Right now, I have a similar position with InnoSwiss, that is the federal agency, the Swiss federal agency for investment in innovation.
Peter?
Yeah, hi. So Peter Plaut. I've spent the last 30 years on both the sell side and the buy side on Wall Street. I'm based in London. I've been there for about 20 years. The last 5 years, I was running the real estate business for a multi-billion-dollar multifamily office. We provided capital on both the equity and debt to various real estate strategies, whether that was industrials, data center, multifamily, hospitality, etc. We also did a bit of metals and mining. In the last year or so, I've been back here between Miami and New York for the time being, and I've been advising family offices in terms of both manager selection as well as and more relevant different opportunities in private credit specifically. So identifying the best of the private credit managers, and whether those private credit managers are doing anything that's non-correlated to fixed income and equity markets, such as litigation funding, whether it was cannabis, whether it was green tech, clean tech, prop tech, etc., or it was simply long-dated, small, mid-sized private credit opportunities and real estate that now is fit into, in many cases, the credit buckets rather than the private equity buckets of these firms.
And before we jump in, I'll just introduce myself. I'm Howard Cohen. I'm an advisor with Strategies for Wealth. Strategies for Wealth has been around for about 90 years. And I work with business owners on their exit strategy, business continuity planning, buy-sell agreements, executive benefit programs, and also we work on a global program for helping non-US citizens obtain life insurance here in the United States as a non-correlated asset for them. And it's something that's an area that's growing quite rapidly. And of course, multi-generational wealth transfer in the most tax efficient way possible, so that when you sell your business, you keep as much money as possible in your pocket, and your family has the money ongoing for generations. So the last 18 to 24 months has been a little different for a lot of people, and it's affected just about every sector of the financial world. So just quickly, I guess, Ellen, how do you see that change in the last year and a half to 2 years has affected the family offices and what they want from their managers?
I have found that there's been some liquidity issues. There's also been some people are sort of stuck in the mud as far as pulling the trigger. There's a lot of conversation about to get up to speed with learning process. There's the latest and the greatest, be it AI or whatever. We want to learn more about what's going on, but actually pulling the trigger and making the investments has been very slow, in my opinion.
And Mauro, are you seeing the same thing in Europe?
Well, you have to say that from the debt point of view, I see that the industry is suffering some liquidity issues, also because interest rates have gone up. We have had a stop on some M&A transaction that mainly were financed by debt. I would say that our investor, both in Switzerland and some of them also in Italy, they still have a pretty high level of liquidity personally, because this is historically the type of portfolio, so they are very liquid in general. This combined with the high inflation has taken us to create some real estate funds at the luxury level. We have closed a couple of deals recently in some prestigious resort, both in Italy and Switzerland, great success. And this is allowing our investors to protect themselves from inflation and still getting a decent return on the investment.
Danye, you said that you work in the area mostly with Asian investors. So to continue with that, has there been a big change in the last year and a half to 2 years?
Absolutely. I've been going to Singapore quite a few times. So I would say in the Asian family office landscape, there's a lot of new families getting started in Singapore that may have accumulated their wealth through traditional manufacturing or real estate or tech, originally from China. But now their offshore vehicle are all in Singapore. And a lot of people may have explored Southeast Asian strategies in the last 2 years. But one thing people would have realized is that there are too much nuances across different countries and regions within Southeast Asia. And if we really want to look at massive domestic market, and if it's not China for global diversification purposes, they have to come to the US. So I guess on the positive side, tailwinds, there's a lot of Asian families, especially those with China origin, for their offshore US dollar asset. There's a strong appetite to come to the US across asset classes. But I would resonate with Ellen. I would say there were 3 things in terms of appetite changes that I've seen across Asian family offices. One is historically, Asian family offices love direct deals, be it directly on the cap table or SPVs. Not to say that appetite has completely dried up, but given the huge valuation correction we've seen in the last year to 18 months, a lot of people realize that it is more prudent to achieve diversification through fund allocation, especially if they need to go all the way around the world. So I guess the first change is that from more direct deals to more of a fund allocation to get that immediate diversification. The second is going more earlier stage. Historically, a lot of Asian families love growth equity or so-called pre-IPO deals with the expectation that it will go, they will get an exit or achieve liquidity in a shorter duration, say 2 to 3 years. And given the market dynamic we've seen the last couple of years, that anticipation, unfortunately, did not pan out. And we don't see that dynamic come back in the foreseeable future. And with the whole AI trends we've been seeing basically since end of last year, there's a lot of Asian families who want to jump on the ship, maybe a too late in the game for large language models, but there's still a lot of opportunities in early stage developer tools and vertical application, and there's a whole host of venture opportunities. A lot of Asian family offices are jumping on. Not to say that the venture allocation is a significant percentage of their overall allocation. It could only be like 1 to 5, 5 to 10%, but they are counting on this segment of the allocation to really potentially achieve outsized returns in the long term. And they have come to realization that in the US and typically in the venture capital world, it is a 10-year duration. And for family offices who do have this long-term vision, alignment in terms of, I guess, the liquidity of fund terms is not an issue. So going more early stage, given in general, the market dynamics and valuation correction, as well as kind of newer disruptive technology trend. And I guess just the final thing is that there's a saying in the market that if you know a family office, you know a family office. So each family is different. But I would say in general, my observation is that either a family really stick to how they have accumulated and created wealth themselves. For example, if it's real estate and the rest of their investments for generations concentrate on real estate, or say if they accumulated wealth through traditional manufacturing, but then they realize maybe their second, third, fourth generation wanted to truly diversify, they enter into different asset classes and have outside advisors, or they hire people to help them truly diversify. And I've seen the trend of Asian families, especially a lot of the wealth accumulation are still just about to transition from first to second generation. There's a lot of interest to go from traditional industries to more tech-driven, more innovative sectors. Which is why like my work is hugely concentrated in the alternative space and a lot of focus on venture.
I was going to ask a question.
Sure.
It's for the forum, but I would love to hear also on the Asian family office side. What's the general asset allocation between alternatives and non-liquid investments to liquid public markets? What do you see?
As we said, you know, one family office, you know, one family office. It's all across the board, I've found.
Have you seen a shift towards more alternative than public lately, or is it unchanged?
I would say one thing about family offices in general, like they typically don't have a mandate to deploy, right? It's not like a manager that I have a certain investment period I need to deploy in the next 2-3 years, and this is the asset I need to deploy. So some of the family offices are relatively opportunistic, right? Mm-hmm. They may have certain thinkings on asset allocation in the beginning of the year, and in the middle of the year, given market dynamic changes or the opportunities that they see, they may reevaluate the speed of deployment and allocation. But in general, especially for the families that I work with, a few of them have tech background. They have a more natural risk appetite for venture-like investment. But for some of the traditional manufacturing and real estate families, I've definitely seen a more interest in asset classes like private credit.
Peter, yeah. So let's take a step back about what a family office is. Family office is to protect multi-generational wealth. So a family office you should view as a bond investment from their point of view. They put principal in, they want to get their principal back and in return the risk that they're taking. End of story. So they might have discretionary capital to be a little more aggressive in one area. At the end of the day, it's protecting multi-generational wealth. I'm very close with the vice chairman of UBS Global Private Wealth Business. She gave me an interesting statistic. The wealth is created by the founders, the first generation. The second generation loses half, and the third generation, it's all gone. Happens. It's a fact. It's a fact. UBS with the Credit Suisse merger now basically controls something like $7 trillion worth of family office wealth. During the pandemic, the family generational wealth went from something like 6 or 7 trillion and then went to 13 trillion. Then a lot of that came back after the markets changed over the last 18 months in terms of correction. But the same phenomenal remains is that it's about protecting the multi-generational wealth. By the time the third generation comes, it's all gone. And then you see a complete dynamic shift in terms of those family offices and those families where the wealth happens to be, except under extraordinary circumstances. So then in itself, the asset classes that make the most sense for a family office is real estate, number one. Number two, it's the businesses that they are familiar with, that they've invested in or comfortable with. And then the third has been, in large sense, has been private credit, more than private equity, more than equities going to the liquid public markets. So what I've seen, I've not seen this in the last decade, is because of the contraction in leverage from the banks, regional banks, et cetera, private equity just can't get the returns that there have been in the past. And that's the same thing in real estate. In the developments that we did, it was always 70-30, right? In terms of the equity being put in. Now for a development deal ground up is more 50-50. That's the case. The IRRs just don't work. So a lot of those deals don't get done. The point that I was simply making is I'm seeing the founding partners, the co-founders of all the big credit funds out on the road over the last 18 months selling private credit. And they set the big return conferences, Super Return and others, where they always had their IRR teams do it. Now they're doing it themselves. What does that basically show? Is that they're basically showing, hey, private credit is going to be where it's at for the next 18 to 24 months or so over private equity returns. And we're also starting to see the shift from pension funds, insurance companies to take a more larger look or allocation in terms of private credit. So I think private credit outperforms. It's usually 5 to 7 year lockups. Private credit can also take private equity type of risks. So we're going to see a bigger allocation from family offices, as well as pension funds and other sovereign wealth funds to private credit. And one of the other things I kind of sit in this kind of, I would say, square, because I sit in London. I spent a lot of time in Dubai, spent a lot of time in the States, Miami, New York, etc. My wife's from Latin America. I sit in Latin America a couple of months a year. So I get to see and speak to how a lot of allocations occurring. And I'll just end it on this, Howard, is that a year ago, I sat at a number of things, MIPIM, Super Return. I was on some conferences for the GRI, and nobody was allocating any credit to real estate. They were just waiting for the next shoe to drop. And in many cases, a lot of the big funds, the low-hanging fruit has been taken. But in the last several weeks, there's been a sea change. Yesterday or the other day, SL Green sold for $2 billion in office tower 245 Park. That's the first time we've seen a large transaction that has set a floor or a market pricing clearing level, so we can find price discovery for the first time in 18 months in the office space. The residential space, both in New York, Miami, Monaco, other places, not the UK as much, there's still this supply-demand imbalance. Roundup development is still not happening in wholeheartedly because you got 7% plus financing and 4% cap rates. The math just doesn't work. And plus, the GDC is 50% equity to debt. So it's going to be harder for ground up development, but there are pockets in industrial, warehouse, others that are still showing a lot of allocation from credit from the big institutional investors as well as family offices. So.
Anything you want to add?
I find that there are specifics, since I deal with alternatives, a lot of times it's venture capital or it's private equity, just sort of one-offs, very interesting niche business that a lot of times the family offices will be laser focused on that particular area. I get your point. I think it's very important. And that would be sort of for the overall view of the family office that, okay, now we're going to switch our percentage more towards credit because that makes much more sense now. But I still find that there's a lot of early stage venture that is of interest. They're very persnickety.
Taking more time.
Mauro,
Yeah.
Mauro, when we were speaking earlier, you mentioned to me that one of the areas that you're working in Europe is the digital asset exchange, and explain to us how you as a manager bring that to the family offices and what kind of effect that has. First, define that.
Well, Yeah, when we talk about a digital asset, we are talking about securities that are registered on the blockchain. So we're just using the technology in order to distribute the securities, but the meaning of the security and the content of the security is very traditional. We are talking about bonds, shares, and so on. With the DLT Act in 2021, Switzerland has allowed the possibility of registering securities on the blockchain, like, for example, shares. So we are using this technology. We are helping one of the top 3 insurance in Switzerland that has a 100 billion asset under management to build a real estate fund. As I completely agree with what you have said 10 minutes ago. So we are focusing a lot on the real estate asset class, and we are building this real estate fund with this insurance in Switzerland that will have the value added that will be tokenized. So the shares of the fund will be tokenized. As I said, we have recently closed a deal in the northwest of Italy, in Courmayeur, that is a prestigious and pretty famous ski resort. We have tokenized a pretty small asset. It's a 10 million deal. We are looking at the second one that will be in Cortina d'Ampezzo, where there will be the Olympic Games in 2026. That will also be tokenized. But the tokenization is just the technology that we are using in parallel to the traditional possibility of buying shares, the traditional way for distributing the securities that actually are shares of the fund or shares of the SPV that we are using for keeping the assets that we have selected and where we have invested in. With, I would say, the plus with the added value that we can create a secondary market on that asset without the need of listing the company or listing the fund on the stock exchange, because in Switzerland, even Liechtenstein, Luxembourg, listing a fund is a pretty complex, pretty expensive procedure. So this would really help even the return for the investor. We have done some feasibility study with this insurance. We have seen that on average, on a listed fund of almost 1 billion asset under management fund, the gross return is 4%. The net return for the investor is 2.27%. If we would use the tokenization, we would be able to save around 1% that we could decide how to distribute between investors and the issuer with a similar level of compliance.
So, Peter, one of the things we discussed is that 2023 is halfway over, and I'm curious to get all of your perspectives if families are more sitting on the sideline much more than in the past, and what do you see going forward in 2023, the next 6 months and onto 2024?
Well, the interesting thing about family offices, unlike funds that track an index, like the Lehman index or something like that, when they were there, or the Bloomberg indexes or something like that, is that they don't have this relative allocation decisions that must be met each quarter, each month, etc. They can sit on the sidelines. So, it's patient capital. So they don't need to be invested. Okay. The one thing that I am seeing, though, is a lot of frustration. Last week I was out with a number of family offices, some rather large, and they're basically, the guys need to get paid. They get paid by putting stuff to work, while the families might not care. So they're looking for deals to get done, particularly since We're going into July very soon. So July, August is dead. You come back September. By the time Halloween turns around, fourth quarter is done. So most of the decisions have been made already between January and June to put something on. If they didn't put anything on, pretty much not going to go full on the rest of the year. The biggest thing, the ones that are focused on the real estate side here, and they might miss some opportunities, is this: they're just so focused on where cap rates are and where financing is, they just can't get around where the seller is and the buyer is, even if it's from a longer term buying perspective. That pricing discovery has been hurting them from really getting large into particular something like that. I've also found a lot of before going into the year, there's some co-GPs on some real estate projects, and one of the co's dropped off, and they're finding it more difficult to replace that one in terms of finding the equity. So I think it's going to be more of the same between now and year end. They sit on the sidelines. But I'd also say that's the same thing I'm seeing in my surveys of institutional investors. That's pension funds, some of the credit funds, or private equity. They're looking for the credit markets to continue to break. There is nobody that's basically saying we're going to see a free flow of credit. Regional banks are going to see more regulation, which means that the larger banks are going to take over. Capital is going to be scarce. Capital scarce means rates are going to be higher. Capital is not going to be deployed. So it's going to be a very difficult financing environment. And that also means there's going to be less leverage available, which means returns are going to be lower.
Danye, do you see the same thing happening in Asia?
I think for my families, especially those with tech background, they are still active on the early stage venture side, actually more active than last year, especially given the current trend of generative AI. Private credit, interestingly enough, last year there were actually more inquiries from Asian families than this year. The reason being, if they put money in the bank, if they don't sacrifice liquidity, last year they're probably only getting like 0 to 1-2%, but this year they can pretty much get to 6%. So are they still want to get low teens return, lock up 5 to 7 years, or they would just park it in money market or any sort of like banking products, and then wait for the equity market to bottom and re-enter public equity when the public equity opportunity returns. So I think that is a big debate for a lot of the Asian families who are historically more used to at least mid-teen or maybe even around 20% returns in the alternative. So that is a struggle when it comes to private credit or a certain type of real estate investment. But when it comes to early venture, I guess the benefit is that the potential return can be outsized, and also the initial capital requirement is not that significant, especially if you look at early stage venture. You're probably deploying 1 or 2 million, or up to, like, I would say my family's sweet spot is 2 to 5, but they rarely go above 5 million per opportunity. So you can invest in a lot of opportunities in the early stage venture capital asset class, even if you're not putting too much capital to work. And I would say that is what I've been seeing recently.
Ellen?
Do you still, Danye, find that they're interested in investing in US venture capital?
My whole mandate for these Asian families is to help them diversify globally, and US probably have the richest and deepest capital markets and probably the most cutting edge technology, especially when it comes to software, deep tech, and biotech. So those are the sectors that I spend a lot of time on.
Yeah. I mostly, almost exclusively, I tried dealing in the Middle East, and that was a bit tricky. But I do find that I mostly deal with the US family offices, and they're still very much interested in early stage. And that I find very exciting. That's sort of my sweet spot. I just find that they've been very slow to invest. Also, they do invest smaller numbers, but they like that early stage. And I that's my sweet spot.
Mauro, what do you see with the families in Europe? What they really are looking for, and also are they sitting on the sidelines more, and are they more involved in directing the managers what they want done?
So I can speak for our family office. When we select a manager, we really look at the track record and the experience of the manager, clearly depending on the type of fund that we are setting up. We may use a structured procedure for selecting the manager. That means sometimes we work with external agency. We create a long list, and then we go down until we get to a short list where we take the control of the manager selection. Recently, we have, recently in the last 2 years, we have integrated the management mandate also with ESG criteria, where we set also some KPIs about that. The remuneration of the management clearly is matching the KPI that we are selecting. I would say that one very important thing for us is the risk management procedure of the manager. This is something that we really look in deep. We wanted to understand that clearly the type of investor that we have are very sensitive to the risk criteria. As I said, that we are investing, they are looking for an asset class like a real estate that is more like preserving the principal than getting amazing returns. We tend also to get in very deep due diligence by the end. So we have clearly personal interviews, but we want also to speak, if possible, with the team of the manager. We wanted to have discussion and maybe to have a deeper look on the procedure and the technicalities that the manager is using for managing the fund. In the past, we also have applied some quantitative model for the selection of the manager. So with regression or alpha calculation on the track record of the management in order to understand risk-adjusted return and potential creation of an alpha based on the investment that has been done. This is more or less the procedure that we are following. So it really depends by the type of fund, the size and sector where we are. Then we decide how much structured is the procedure to select the manager that we want.
So we have about 5 minutes left. Why don't each one of you just give a recap of what you see?
You want to open up to questions from the audience?
Oh, sure. Anybody? Usually people just chime in.
I have a question. Do you have a question? Yeah, is there an imbalance in the way people are allocating the portfolio these days because there's not marketing things to market in private equity space and venture capital? Do you feel that? Like family offices saying, hey, my consultant already told me I allocated too much money to XYZ venture capital or private equity and I'm holding back on allocating anymore?
I'm hearing that more, Marty, on the pension side, actually, than from the family office. But again, I only deal with a couple, but a lot of the pensions were over allocated to private equity, particularly when I saw a number of the mark-to-markets fell. We're all of a sudden over allocated. Now, what are they doing with that? And they're going to the Axias of the world and the other consultants and trying to figure out how to rebalance that. So that's where I've heard and witnessed the over allocation.
Part of the fuel of private equity has been cheap credit. Any thoughts on that?
That's what I've been talking about,
Yeah,
is that
exactly.
private equity doesn't get the leverage anymore that they've had in the past. So two things are occurring. One is they're gonna have to settle for lower returns than they have in the past. And then the LPs are gonna have to be happy with that. And if they're not, we're seeing a shift to private credit. And if you look at some of the larger institutional funds, private equity is a much larger business than the private credit. Now, private credit, many of them, you go to the Fortresses of the world, the others, KKRs, private credit is a larger portion than the overall fund. Private equity has become smaller, but the private credit has been able to do more tactical type of opportunities, where they're actually doing private credit in many cases within their funds.
So I have a faith in church question. So in the church is the Fed. And so a lot of people, you go to Silicon Valley, like we were just there last week, and they were all saying, well, you know, as soon as the Fed starts cutting rates, we're going to be in good shape. Same thing, you talk to real estate guys out in Texas or Los Angeles, they say the same stuff. Do you anticipate the Fed cutting rates anytime soon? And do you anticipate the Fed ever cutting rates again to the low amounts that we had post 2008? What are your thoughts? Any thoughts on that policy?
I haven't thought on that.
I know you're a brave guy, Peter.
No, but I haven't thought on it because it's not my opinion. It's just, you know, I'm always speaking to institutional investors and others. And so, well, first of all, rates are going to, you know, we're not going to see a fall off in rates significantly anytime soon.
Okay.
The regional banks, okay, are going to be stymied by the Fed and the other regulators. They're not going to be able to lend. They're going to require large capital. We're going to see a consolidation among regional community banks, among the larger banks, as we've saw with SVB and Republic. That's going to be also mean that there's going to be a less free flow of credit available, which means also forget about going back to the global financial crisis where we had all these, everybody running for the hills. We're not going to see that. What we're going to see is an Ivy drip, where basically the economics might not work. So, and we're seeing this already in some of the big funds, if you read The Real Deal or some of these others, where we're seeing large portfolios of loans being sold to the Starwoods of the world and others, okay, that they're picking up. And they're not being sold on 40 cents on the dollar. It might be 96 cents on the dollar. People don't like to be told that their portfolio sucks and to sell it at a discount, right? So the reality is we're going to see more companies like LNR, which is the largest servicer in the world, that's owned by Starwood, going out to banks and insurance companies and pensions, sovereign wealth funds, and basically say, let us advise you on these portfolios. And if the math doesn't work or so, they might be willing to sell them. So we're going to see more of performing loans, not necessarily non-performing loans, and not necessarily distressed or stressed, being sold. And they're going to be sold in big portfolios to those that have more experience in that, as the large alternative investors, the credit funds, et cetera. So you're going to see that. And that doesn't also mean that we have a normal, healthy environment where rates come back down. Basically means there's going to be cracks in credit. And we're already seeing that. We have been seeing that in the CMBS market. So, the markets are not functioning as smoothly and efficiently as they had 18 months ago. And that's not going to change overnight. That could be 12, 18 months or longer. So that's what we're facing. So the guys that are basically saying, oh, we're going to wait until the rates come down in Texas, like you said, or in Silicon Valley, and everything's going to be fine. That's not the case. The free flow of credit is going to be stymied for quite some time.
So, sorry, Peter, based on what you said, so what are your clients' return expectations when it comes down to, for example, real estate equity transactions, right?
Well, let's look at real estate, for instance, okay? I'm not an expert in it, but I finance a lot of it and have financed a lot of it, okay? So if we were looking at IRRs, and I'm not talking about value add core plus, but some development, hospitality development in St. Bart's, St. Kitts, Miami or something like that, you're trying to get mid to high teens type of returns. That's not going to be there anymore because you're not getting the leverage. So that might be in the high single digits, low teens, and you might have to settle for that. But that's going to be a hell of a lot better than what it was in core markets where you're getting 4 or 5%. So there's definitely been kind of a doubling of that expectation. But for the investor point of view, the returns are not going to be as easy to find.
But just as an aside, which we were talking about before, I found this interesting. The selling and reselling of credit. There's something out there now, and you might have seen it in the Wall Street Journal last week, called zombie mortgages, which people who had lines of credit in their private homes that in 2008 they weren't able to pay back their loans, and they sort of went dormant on it because the lenders disappeared. But they thought they were finished with those lines of credit, and now there are more and more homeowners getting notifications that they now have to pay the piper on these lines of credit where they might have had a $50,000 line of credit, but amortized over time with interest, and now they're getting hit with bills, so to speak, of $100,000, $150,000, $200,000, and the banks are threatening to put them into foreclosure if they don't start paying, because then they thought that because the banks had written them off, that didn't mean they closed the loans.
Yeah, I'm actually seeing less of that because if you look at, if you bought a home 5 years ago,
This is,
10
I'm
years
talking
ago,
about from 10
I
2008.
know, I understand, but we've seen a significant rise in
Appreciation.
value. There's a lot of equity value in people's
Well, and that's why the
homes.
banks are going after it,
Right.
because the interest
So-
rates have gone up and the equity's
But in
gone up.
many, even with the interest rates higher, they still have a lot of equity.
I want to
So-
table that question and get to my question, which I think is far more important. So in Silicon, and I'm modest, in Silicon Valley, we were there last week, and so the thought was a lot of the secondary firms have really been holding the market with like private deals from just, plummeting. Because there's so many secondary firms compared, like in 2008, there was really $5 billion secondary funds. Now there's $10 billion secondary funds out there, right? I mean, there's a lot of secondary funds. And they think that they've been holding the lid, from just everything imploding. And so now a lot of secondary firms are saying, well, we're kind of done on being strategic in what we're doing. Any thoughts on that? Because, secondary spreads went to 70% in 2009 and 2010, right? So on private equity and venture. So any thoughts on secondaries?
I have a lot of people that are involved in that space that I speak with, and a lot of LPs that are looking into secondary funds, and that continues to increase. So I hear what you're saying on that side, but I'm still seeing a lot of interest in secondaries.
It depends on the spread.
Depends on the spread.
Yeah, what price? Yeah. Some assets are great. I mean, our real estate guys will go, some assets are great at certain prices, they can do anything with them. So why don't you guys wrap up? I gotta get more highlights.
Yeah, I think we should still look at each underlying asset specifically based on their own merits. Last year, we already experienced a lot of valuation correction, and this year we've seen more of that, and the spread has compressed both for venture and growth equity. But there are certain opportunities that may never recover. So it's important to evaluate each deal based on its asset class, based on its own merit. I do know a lot of funds that may or may not historically run secondary funds have started some sort of a secondary place or a parallel fund to take advantage of their existing portfolios, but now they have a very attractive re-entry point, but they've already done a lot of the work to their existing portfolios or have built deep relationship to the management team of the portfolio companies. So that is an area that I've been looking into. But again, I think from a manager and advisor's perspective, safeguarding family office asset, we need to be very prudent because maybe last year 50% discount sounds attractive. This year, 70% discount sound attractive. But it doesn't mean if you evaluate given the current market condition and newer technology trend, it will still be an attractive valuation.
I have a much more simplistic question. Just interesting as an external advisor to a family office, how do you structure your comp? Are you compensated directly by the family office, or you compensated by the manager, or combination?
In my experience, it's a combination of asset-based fees and retainer if there's a lot of pre-work or research-oriented work before you kind of fine-tune the actual allocation portfolio. In rare occasions for emerging managers, because a lot of my job is helping the families to get allocation to capacity-constrained investment opportunities. So there's no way that you are getting any compensated by the manager of the deal side. But a lot of the family offices have done SPVs where they do structure the opportunity set with some sort of embedded fees, and in rare situations with emerging managers that I've done some negotiation on behalf of the family with the emerging managers, and sometimes that fee discount either get passed through to the family, or I would disclose to the families that I'm taking the difference.
Mine's combination retainer and deal. So if I bring a private deal, whether it's a real estate deal, litigation funding deal, or someone, company will pay because I'm bringing the company to them, and it's, whether it's debt or equity, real estate developer, same thing. But if it's a simply helping them with manager selection, allocation, etc., it's a retainer with the family office.
Fantastic, guys. Great job. Thank you.